Before we move on to the business review, I just want to share. We had a very good 2017. We are overall about 37% growth in the profitability, and then more than happy with the recognition that was given by some of the international awards, especially the Global Finance Award. It was chosen as the our semi-bank in Sri Lanka, and also for the best retail banking product. That's for our Dreammaker personal loan portfolio. And last year, we also saw our launch of the Transformation 2020 strategic plan, which we devised with some professional input from International Financial Corporation, IFC's advisory team. The ultimate goal is to convert NDB Bank as a more systemically important private commercial bank by 2020, with a growing our asset base at a rate of around 20% annually, and also a liability-driven strategy where we would have our own funding to support our growth, and also the business focus more coming from the retail, the business banking areas, whilst also growing our corporate and the project finance book. So the strategy is well on track. We have made major investments as well in terms of IT field and also in developing staff, aligning the entire staff into one NDB team, and that has been progressing quite well. And some of the results, especially the first quarter, are some of them are driven by some of the strategic initiatives that we have already launched in second half last year. Moving on to the financial performance, the key performance indicators for 2018, the first quarter, mainly driven into 4 quadrants: profitability, balance sheet, the efficiency ratios, and also the business capacity. In terms of profitability, we'll be discussing more in detail, but NII was up by 44% compared to the similar period last year, to 3.3 billion rupees. Net fee and commission income has grown by 28% to 710 million rupees. Total income has grown by 44%, and total operating expenses that has managed quite well despite the VAT increase and all, 12% increase. And all in all, the profit after tax has grown by 35% year on year to 1.561 billion. And the group profit attributable to the shareholders has up by 56% to 1.152 billion. In terms of balance sheet, the total asset growth for the 3 months was 3%. We have touched 396 billion. The net loans, again, a 3% growth to 282 billion. Deposits, around 4% growth to 284. So first time we have outgrown the deposits. Deposit figure is now above the advances figure. And total assets of the group level has crossed 400 billion rupees. In terms of efficiency, the cost-to-income ratio that has improved quite well to 35.8% from 45%. The net interest margin, that's something that we are working very hard. It has improved to 3.49% from 3% last year. And return on equity, that also has improved from 16.2 to or almost 16.8%. And the return on average assets has improved from 1.2 to 1.26. Business capacity ratios, loan to deposit, as I mentioned, that has now improved to almost 100%. Tier 1 and Tier 2 capital level well above the statutory minimum requirements. Tier 1 at 8.73 and Tier 2 at 13.35. And the liquidity coverage ratios are well above the minimum statutory requirements. Moving on to the income statement in detail. As I mentioned, the gross income, we had 20% growth quarter-to-quarter comparison, where we ended up with 1.9 billion increase for the quarter, 20% growth. Total gross income was 11.9 billion. Net interest income, that has the highest percentage growth, 44% growth. So the gross income level, it's 20% growth, but NII has grown by 44%, reflecting the improvements in the margin. Actually, the beginning of last year, or the 2016, the NIM was 2.6. So we are coming from a position where the NIM 2016 was 2.6, now moved up to 3.49, so almost 90 basis point improvement in NIM. Fee and commission income, again 28% quarter-to-quarter growth to cross 700 billion. So overall operating income has grown by 44% to 5.4 billion. Impairment charges, of course, there's a sizable impairment charge compared to the first quarter last year. One was on prudency basis that we made certain impairments. Also, there is a trend also in the industry, in the NPLs gradually picking up. Of course, we are relatively better than industry, but we were prudent in providing some impairments. And also the IFRS impacts also would have been taken into consideration when he put some impairments. So net of impairment, the net operating income has grown by 27% from 3.6 billion to 4.6 billion, almost 1 billion increase in the net operating income level. The total operating expenses, the growth, as I mentioned, was 12% from 1.7 to 1.9. We have been curtailing the expenses wherever possible. There's a very good cost management discipline that has been introduced. Cost champions appointed to ensure that the controllable costs are managed, and that exercise will continue to progress to ensure that our cost income ratios are maintained well within the requirements that we have. And all in all, operating profits have grown by 40% from 1.9 billion to 2.6 billion. Of course, tax component is quite sizable. One is the tax rate has gone up. So that there's a 48% increase in taxes. So for the first quarter, we have made provisions of 1.1 billion paid as taxes. So profit after tax, we had 35% growth from 1.1 billion to 1.5 billion. And the group level profit attributable to the shareholders, that also had 56% growth from 738 million last quarter, 2017, to 1.1 billion in the first quarter, 2018. Further analysis of the revenue. Interest income has grown by 16% from 8.5 to 9.9, while the interest expenses, that has grown by only 5%, from 6.2 to 6.5. So it shows the improvement in NIM, 44% improvement, that also resulted in 71% basis point from 2.78 to 2.49 NIM improvement. So it's mainly coming from the interest income side, and also interest expense, though our deposit portfolio that had the highest growth last year, we had almost 70 billion new deposits that came in. That shows that the deposits have come at a reasonably good cost, Also take into account the CASA contribution, which was last year, it was about 12 billion. So all in all, that all have contributed to improve our NIM in this manner. Further analysis on the other income. There again, net fee and commission income, 28% growth to 700 billion. Net gain from trading, 30% growth from 273 million to 355. And there's a gain of 300 million in the financial investments, mainly on the treasury bond side. And also the other operating income, 13% growth from 600 million to 683 million. So all in all, the non-interest income also growth was 44% from 1.4 billion to 2 billion. The beauty is that the revenue has come from all business segments, corporate, retail, business banking. All segments have contributed equally for this growth. And we would continue to focus more on the retail and the middle market side, where we see the opportunities given our branch presence in 107 branches. Of course, the comparatively high gains from ALM also contributed to this other income, which was the 300 million that I mentioned earlier. Operating expense side, overall 12% growth in operating expenses. Personal expenses, 11% growth from 900 million to 1 billion. Naturally, one is the staff increase. We had roughly about 100 staff increase from quarter last year to the quarter this year. Apart from that, the salary increments and all. Then the other expenses, 16% growth, that also covers the VAT and other administrative expenses. But still, I would say the 12% growth is commendable, but I think still we are working on further improving this on the cost management side. Now, why I'm saying that it's commendable is because we had some big investments. We had new 3 privileged banking centers that were open. Of course, this cost base is also with the increase of the branches that we had last year. Relocated branches, their cost elements are higher, so that contribution, quarter-to-quarter contribution, when you compare first quarter 2017 compared to that this year, we had 4 more branches also added to the network, apart from the 3 privileged centers that we opened during the quarter. And also we went on with introducing cash recycling machines and also some branch relocations as well. So despite that, 12% growth in cost is, I would say, quite well managed so far. But of course, going forward, also with the salary increments and all, we might see slight growth in this, but that's where we are working on improving the controllable costs through appointment of certain cost champions. Balance sheet, I would say it's a moderate growth for the first quarter. Of course, we are coming out from a December balance sheet where we had exceptional growth towards the latter part of December as well. So overall, the growth in balance sheet is 3.3%. From 383 billion to 396, about 13 billion growth. Of that, the loan growth was almost 3%. Deposits, 3.8%. In terms of quantum, 10.8 billion in deposits and 8 billion in loans. Group level, the total assets have crossed 400 billion, 401 billion as at March, from 389 billion a year ago. That again about 3% growth. Loans and receivables, the comparison is there, the quarter-to-quarter comparison. The first quarter 2018, it's a moderate growth. Coming from term loans, trade financing, and also consumer loans. Corporate banking accounted for the highest portion of the growth, but we have seen the retail and middle market also pitching in with certain growth towards March and also in April. And in terms of the currency composition, the local currency to foreign currency mix has improved now to more towards local currency, 78%, and 22% foreign currency. You may recall the beginning of last year, this was roughly 75 to 25. So that is one of our strategic imperative to move towards more LKR-based lending book. So we have moved on to about 78% in the local currency. Asset quality, NPL ratio has slightly deteriorated from December figure, but still above the industry average. Our NPL ratio has gone up to 2.46%. Industry average is around 3% as at March. Of course, we have seen certain pressure on some other portfolios, which is industry-wide phenomena that we have seen, not limited to any specific client, but we have seen some collection issues, which is the case with the industry. Naturally, with a growth rate of a low growth rate, as the country had a low growth rate last year, so naturally there's a stress level that is reflected in any bank portfolio. But we are upping our standards, at especially the monitoring level, because nothing to do with the underwriting standards. Underwriting standards are quite good, but it's basically follow-up, general delays in some of the collections. So wherever we need to help our clients, definitely we help them. But we will also enhance our monitoring and collection arrangements to ensure that the trend, till we manage this trend properly. Portfolio is quite diversified. Asset quality-wise, you will see quite a well-diversified portfolio. There's no concentration risk in any particular area. But we are, with this more monitoring, proactive measures and all, we expect this NPL ratio to improve as we move along towards the latter part of the year. Talking about deposits, again, quite a good growth. All in all, 10.8 billion growth in deposits. Again, the composition, 82% of the deposits have come in LKR terms, 18% in foreign currency. CASA, of course, as a ratio, we maintained 22% CASA ratio. So of this 10.8 billion, 22% of that has come from CASA. But naturally, in an environment where the saving capacity is also getting limited, maintaining a CASA ratio is a challenge for any financial institution, but we will be working hard on improving this to ensure our cost of funds are managed further down. Of course, we have a couple of products and CASA-driven strategies that we have launched in the first half. So we will be looking at reaping the benefits of such arrangements in the coming months. In terms of capital ratios, we are quite okay in terms of the minimum capital requirements. Tier 1, 8.73, group level 10.1, Tier 2, 13.35, the minimum requirement is 11.875. So we have roughly about 150 basis points above the minimum requirement. Group level, it's 14.4. So we are meeting the matrices. We are well within the risk parameters for in meeting these capital requirements. However, looking at our growth opportunities, looking at the impact on the IFRS 9 and all, we'll be looking at capital infusion going forward during this year. Investor ratios, of course, the share price remains almost at the same range compared to last year, maybe 136, the closing, year-end closing, and now it's 133. It was hovering around 134. Earnings per shares has improved from 24 to 27. These on annualized basis. ROE has improved from 16.2 to 16.78, and ROA from 1.2 to 1.26. Book value per share remains at 167 rupees, and also the price earnings 4.82. We would be focusing on the ROE side. So the 16.78 ROE compares quite well with the industry ROE of 17.1. But we are comfortable that we should be able to cross these industry level averages as we move along, especially on the profitability side. And I would say NDB share continues to be an attractive buy since it's trading below the book value. So these are basically the industry ratios, investor ratios that have been shared with you all. The formal presentation is that's what we have to present, but I'm sure you all have enough questions. So myself and my colleagues from the bank would be happy to answer whatever questions you may have. So you can post those questions, and I will read the question as well and then provide the answers along with my colleagues. Thank you. What are the plans to sustain CASA at tolerable levels? Yes, and you want to share that? Sanjay is heading our retail network, so I would ask Sanjay to answer that.
With our transformation 2020, as you know, especially focused on growing the CASA deposits. And if you have noticed, last year we have come out with many new products promoting CASA and also promotions throughout the year. And in the first quarter of this year as well, we had a good, very successful promotion for CASA. So I'm sure with this and with the expansion of the branch network and focus on retail and SME and the segmentation of the current account segment for business clients, we are hopeful that the ratio will improve. Although we have shown a significant growth in CASA, the growth on the rest of the deposits have been at a much faster pace. As such, you will not notice the improvement in the ratio, but we will sustain that and then improve in the future as well.
Okay, I think apart from the products launches that we had, I think the mindset also, we have been addressing the staff mindset to move towards more liability-driven strategy. And in that, the growth in CASA is one of the prime goals. The targets also are given to them. So, but as Sanjay mentioned, one is the product strategy, other one is the incentives, and to ensure that we maintain that momentum. Especially the contribution from business banking clients is also high, because any business banking account, they would be required to open a current account and also have the ancillary other accounts also open with us. So that way, we are looking forward to improving CASA ratio further. There's a question on 2 billion increase in NPL in the quarter. Would you be able to give a sense of which segment and sectors have accounted for this? Bhunika, partly you can answer and then probably Nika.
By and large, it has been in the manufacturing sector. We have seen certain areas of manufacturing sector due to poor collections in the market. We have seen some signs, but I believe that we should get improved as time goes on, especially on the manufacturing.
Apart from that, on the middle market side, business banking side.
Yeah, middle market side also mainly the manufacturing side, mainly due to the poor collection. I think we have experienced the bank are facing difficulty in the collection. So as a bank, what we are doing is we are offering some sort of restructuring until we overcome this situation.
As a question on private sector credit growth is very high at 4.6% year to date, and NDB had a loan growth of 3%. What is your target loan growth for 2018 and 19? Of course, 2018 we will be naturally growing more than the market growth rate. So rather than probably commenting on a figure, it has to be above industry average growth rate. So we'll be working hard to ensure that the next 3 quarters would provide more than what we achieved in the first quarter in terms of the loan growth. But that doesn't mean that we are bringing down our underwriting standards. There are still opportunities, especially in the middle market, the retail side, and also corporate side. So whilst maintaining our high credit standards, there are a lot of still opportunities. So we would look at a higher growth in the advances side in the coming 3 quarters. Niran, there's a question on what's your view on interest rates going forward, and will there be any pressure on NIMs, considering the policy rate declined by 25 basis points in April?
After the rate cut, actually, which is very much clearly stated by the central bank also, that the tightening cycle is over. So we think that at least for this quarter and the third quarter, the rates will remain stable and at the current levels. So that actually puts the bank in a much better wicket, because we are the way our the liabilities been structured, we are in a very good position to expand our NIMs further.
Okay. There's another question on segmentation. Corporate segment currently 57% of the loan book. Do you expect this to continue to be the case in next 3 years from now on, or would you be targeting more on retail and SME? Of course, the 57% is not only corporate; it's a corporate and project finance together. And in this project finance, there are certain middle market clients as well. But of course, yes, the focus would be, whilst growing the corporate portfolio, to concentrate more on retail and SME side, the business bank. That's why we have basically strengthened that segment by carving out a new segment, which is called business banking, specifically to grow that particular segment. And they are working hand in hand with the branch network, making use of the presence that we have, 107 branches, for them to approach those customers at the SME and the middle market level. And also we have a very good personal banking portfolio, the Dreammaker loan, the best personal banking portfolio, I would say personal lending portfolio, plus quite a good leasing portfolio. And the cards are progressing quite well. So we would be concentrating, putting our resources more into growing these sectors, because as I mentioned in previous presentations like this, it's one way to improve our risk profile, spreading your risk. That's where margin-wise also there is better margins. Plus you are touching the customer base of a larger community, and they would also be part of our clients. They will have our normal other operating accounts, so there's a lot more cross-selling opportunities when you grow in the retail and SME space. So naturally, this mix of the balance sheet would shift more towards retail and business banking segments. So by 2020, the target is almost like 50-50 or a slightly higher contribution coming from retail and SME space compared to where they are. Iran, there's a question on, can you elaborate a bit further on 310 million financial investment gain?
It's mainly derived from our bond portfolio, which we managed to realize some of the gains because of the favorable movement in the interest rates.
There's a question on any update on the debt repayment levy. Is it implemented or scrapped? So we have not received any communication from the Indian Revenue about that. So far it's no update that we also can provide. Then there's a question on, is the impact of SLFRS 9 being included in the quarter? Some further analysis on impairments. So, Lalit?
Yeah. SLFRS 9 impact is actually disclosed in the quarterly publication. The impact to what extent is going to be at the year end. So it's about 30 to 35%, rather up to 40% impact on the opening provisioning book. But for capital requirements, Central Bank has given verbally an indication that it will be taken over 3-year time horizon for us to raise capital. But in the books, we'll be adjusting it at the year end, which the other banks also do. It's not reflected in the quarterly financial statements in the balance sheet. It's only a disclosure.
The next question also, I think Lalit has answered that. Basically, can you give an indication on the impact of IFRS 9? So that's where we are looking at roughly around 35 to 40% increase in the provision level, the first day impact. And as Lalit mentioned, the regulator also has indicated the possibility of spreading the impact for the ratio calculations for the over a period of 3 years. There's a question on what will be the increase in annual provisions. Is it the same as 35 to 40? Certainly not. I think this is the first day impact. The first day impact based on when you put the IFRS 9 and then look at the portfolio, you stress your portfolio. Now under IFRS 9, 30 plus entire 30 days in arrears plus any portfolio, the entire portfolio has to be discounted, look at the cash flows, and the impact is assessed based on that. So the first day impact is around 35 to 40%. But going forward, that doesn't mean the entire provision level will go up by that percentage points. But since under IFRS 9 accounting, you need to now impair the entire portfolio. Look at the full tenure of their credit cycle. There will be an increase in the provisions. It's industry-wide. There will be an increase. The indications that we have received from the audit firms is roughly around 10% increase in general provisions. So it's not unique to a particular bank. I think industry-wide, we can expect roughly 10 to 15% increase in the overall provisioning because of the IFRS 9 accounting treatment. Any other question? No other questions, right? Okay, there's one that we just received. What is your strategy on digital banking side? Sanjay, you want to touch upon that?
Yeah, I think we already have the best mobile banking application which we want to further enhance on. And also we have for the business segment, we have the e-Windows platform that is being used heavily by both the corporate as well as the SME sector. And you would have noticed that we have launched the cash recycler machines in certain strategic locations where you can facilitate deposits as well as withdrawals. And also the tab banking, which is launched across the branch network, going into the doorstep and collecting cash and opening accounts. So those are the digital channels that we have now started, and there are a few more initiatives that we are working on, which will come into effect in the future.
I think we have set up a separate digital banking business unit itself. There's a team who's working quite hard on that area. So as Sanjay mentioned, we have made some good head starts in terms of the mobile app. Branchless banking, right now we have the branchless tab banking that is being practiced at about 25 of our branches, but that will be launched to the entire network. Apart from cash recycling machines, we are looking at having few digitally focused branches going forward, because rather than a brick and mortar branch expansion itself, we are looking at a digital avenue as a major contributor going forward to grow our balance sheet. So already that the progress, it's taking progress. Got some good professional input also on this. So we are working on the digital strategy quite well. There is a question, there are specific advantage of the current LKR depreciation given higher exposure to foreign loan segment. Lalit, you want to contribute?
I tend to comment that there is no distinct advantage as such, unless Niran, you want to.
No, actually, what happens is like it's basically both the assets and the liabilities get revalued, so it's basically net off. So from the balance sheet point of view, it's not much of a difference. But only thing is the only reflection part is your offshore profit component, which is in US dollar terms, which will get revalued and show a slightly higher profits. That is generally that is the normal course of anyway from the normal years also we get it. But here now we have seen a bit of a steep evaluation during the last 2 months, so that might get reflected in the June numbers.
As a general question about how is the macroeconomic growth this year, and do you expect continued stress on NPLs at the industry level? I think it's an industry-wide phenomena. I think it's not fair for me to comment, but a general comment, yes, naturally this is the cycle that we have seen over the years. Whenever the growth rate is low, then naturally there is a lag effect. The NPLs are going to pick up. So we are going through the same cycle. Last year we came up with a low growth rate, and naturally we can expect some stress level in the portfolio. So I would say the industry level, which we have seen already, the industry level NPLs picking up to 3%, which was somewhere around 1.8 the beginning of last year. So there can be a trend. So I think the banking institutes, the financial institutes have to brace for this kind of situation, improve your monitoring mechanisms, and wherever the real situations are there, we should also help our clients and improve our standards of monitoring. Okay. I think these are the only questions that we have received. So we would like to thank all those who have logged into the webinar. Good questions. We would continue to have this kind of quarterly webinars to share more details about our progress. So thank you very much for joining in locally as well as from overseas, and looking forward to working closely with the investor community, and hopeful that we can meet up again in a similar webinar in 3 months' time. Thank you.